Markets are showing their resiliency as several headwinds from the debt ceiling, regional bank drama, the hawkish Fed, well, they've all become tailwinds over the past couple of weeks. Our next guest thinks we've seen the last of the rate hikes in this cycle and that more mean reversion for the market could be coming. Art Hogan, I like this take. Okay, so you're not in the skip camp, which says they skip and keep going.
Yeah, I think, President Kaplan just did a great job talking about what's happening as an offshoot of the regional banks, right? And so we knew this was going to come about. And so clearly, the Fed always wanted to see credit tightening. They didn't want to do it by having four banks go under the waves, but it's been thrust upon them. That probably equates to 50 basis points in hikes.
Wow.
So they have to calculate that into where they think their terminal rate is. If you take the new treasury issuance, that's likely to be a drag. You'd call it 25 basis points. So they've already got 75 basis points that they didn't have to do. On top of that, owner's equivalent rent is about to be recalibrated this month. And when that catches up with real estate values like Redfin and Zillow that have been telling us since last July, real estate values are coming down, you're going to see a CPI and a PCE that's got a 3 handle by August.
But they're going to go, course 4.5%,
right.
And wages, unless the labor market buckles, they're going to be concerned it's going to stay too high.
Right.
I'm curious, though, about the market. You don't sound like you're chasing the NASDAQ here.
No, well, I think that the NASDAQ's done a nice job of leading here because it's been what you go to while the Fed's still raising rates. When the Fed gets to the place where they've stopped raising rates, the market tends to be, let's find out what we missed along the way. And what did we miss? We missed the entirety of the Russell 2000, which, oh, by the way, is starting to catch a bid. We missed everything that's not technology, communication services, and to a certain extent consumer discretionary, which is mostly Tesla. That has been the leadership, right? And it's likely overdone to a certain extent. And now you get that mean reversion or catch-up trade, which is small and medium cap. That's why the Russell 2 is catching a bid in June. I think you're going to continue to see the underperforming sectors like healthcare and energy start to get some sponsorship and start to catch up. And that happens every cycle. The Fed tightens. Everyone's flocked into that sort of mega cap harbor of safety because they've got fortress balance sheets, defendable cash flows. And I think that's a bit stretched.
Quickly, why does new Treasury issuance of $1 trillion or
right.
something like that, why does that do some of the work of the Fed?
Well, the theory here is that crowds out money that otherwise would be going.
It absorbs
right.
money.
But if you actually look at the repo market right now, that's going to be absorbed pretty easily. I don't think it's going to be a headwind for equity markets.
So let's get to equities and zero in on a couple of names that you have your eye on right now.
Right. So the first is TJ Maxx, right? So a retailer that's got the perfect size footprint in a slowing economy because the treasure hunter and the person that's a value shopper continues to go there. So it's got a cult-like following. They continue to be a beneficiary.
Well, it does in my house.
Yeah, right, exactly, right?
Yeah.
And they replenish their inventory so often because big box stores that are over-inventoried, that's their discount channel, right? So they do very well. Another name that sort of pops up on our screens now is John Deere. And John Deere is going to be the beneficiary of all of the money that we're going to spend on infrastructure, on top of the fact that they're making farmers more productive with the technology that they have. And I think it's an incredible name trading at a very reasonable valuation.
Even though you're concerned about the economy overall, wouldn't that, hurt ag prices, hurt, things like that? Well,
hurting ag prices might not be a bad thing for us because that's been a major input to the inflation, right? So, but it's much more of the how do you become more efficient as a farmer? Use less water, use less fertilizer. It's the targeted approach, and John Deere is able to do that with the latest technology that they're rolling out.